Recently, a set of sovereign gold bonds or SGBs issued by RBI in 2016 matured. Investors in these bonds made a 15% per annum return, much better than any FD or even some equity funds. People are asking today, should they invest in the current series of SGBs? This is the time to give the disclaimer, past performance is no indicator of future returns. Hi, I am Aarati Krishnan and today we are going to talk about sovereign gold bonds, how they get their returns and how they compare to other ways of investing in gold. SGBs or sovereign gold bonds are Government of India borrowings which give returns in terms of prices of gold. So, this is how SGBs work. You buy the SGBs issued by RBI based on the current price of gold per gram in the market. 5 or 8 years later, the SGBs are redeemed at the price of gold as on that date. Apart from this, the government also pays you an annual interest of 2.5% on the face value of the SGB. So, today if you subscribe in the February 2024 SGBs at 6263 per gram, you will get an interest of about 16 rupees a year for the next 8 years. You can exit these SGBs either at the end of 5 years when RBI offers a buyback window or at the end of 8 years when they actually mature. The price you will get per SGB will be the prevailing price of gold at that time. Now, suppose gold has become 12,000 rupees per gram at that time when you are getting out, then you will make a return of 8% per annum based on your buy price of 6263. Can you be sure that gold prices will be at 12,000 rupees per gram say 8 years later? Nobody can tell you, right? That is why the past returns of SGBs cannot be extrapolated into the future. So, what kind of returns can SGBs give you? How do you arrive at that? Many people in India think that gold prices go only one way and that is up. They are quite wrong. Actually, the gold prices in India depend on two factors. The first is how global prices of gold are moving in the international market. India imports most of its gold, so the domestic gold price is determined mostly by global gold prices. The second factor is the rupee's movements against the US dollar. If the rupee is depreciating against the US dollar, domestic gold prices tend to go up and investors in gold make a higher return. If you look at the past price movements of gold in global gold prices, you know that about 20% of the years since 1990, gold has actually made a loss. So, the thought that it always goes up is wrong. Secondly, in about 30% of the years, gold has given less than a 10% return. Therefore, there is a half and half chance that you will not get to a double digit return if you invest in gold. This apart, what about the rupee depreciation factor? Across the last 30 years, the rupee is depreciated at the rate of about 3 to 4% a year against the dollar. So, this has added to the gold price returns also. In future, if this kind of depreciation sustains, then you will get an extra return on gold prices, otherwise you may not. So, how does gold as an investment compare to stocks or bonds? You should be aware of one key difference. In stocks, actually the trend over the long term is upwards because the earnings of the companies that are backing those stocks tend to go up over time. In the case of bonds, the bonds are backed by interest payouts, so there is a cash flow to the investor. In the case of gold, there is neither an earnings nor a cash flow to actually back your holdings. Therefore, your gold price returns are determined wholly by demand and supply factors and how they change over time. So, having said all this, there are only two reasons why you should invest in gold in any form. The first is basically as portfolio insurance. Whenever there is a big global crisis, talk of banking collapse or a housing crisis like we saw in 2008, gold prices tend to shoot up internationally. That is when domestic investors also make a lot of returns. But insurance premium can never be 100% of your savings, right? So, that is the reason why you should invest only 5 to 10% of your portfolio in gold and not more than that. Now, the second big reason why many Indians invest in gold is for weddings, right? They are saving towards buying jewellery or they want to gift jewellery or gold at the time of the wedding. Now, if you are looking to buy gold for weddings, the temptation is to buy physical gold bars or jewellery and stock it, right? But what happens is when you buy physical gold, you incur a lot of making charges, wastage charges and so on and so forth. At the time you want to actually sell the gold and get cash, it becomes very difficult because the jeweler takes it back at a hefty discount. Many jewelers also refuse to give you cash for your jewellery and they will only allow you to exchange it against new purchases. When you buy gold in digital form, either in the form of SGBs or gold ETFs, you do not suffer from these disadvantages. These are basically exchange traded mutual funds that invest in gold and allow you to track gold price returns just like SGBs. Only thing is they do not pay you any interest. There is one respect in which SGB is vastly superior to ETFs because the government is floating them. The government exempts any capital gains on SGBs completely from tax. So, if you make a 15% return from SGBs, you get to retain it completely. Whereas in gold ETFs, if you make the same 15% return, the return will get taxed at your slab rate because that is the taxation structure for ETFs. But then many people who are active investors in gold prefer to invest in ETFs over SGBs because they can buy gold at lows and sell it at highs. With SGBs, you are forced to buy SGBs only when the RBI issues them and redeem them at a time that RBI chooses. So, this flexibility in actually trading at lows and highs makes some people prefer gold ETFs to SGBs. Based on whether you plan to be a buy and hold investor or an active investor, you should make the choice between SGBs and gold ETFs to own gold.